All right, we are trying to figure out how to get a countdown going here because apparently the clock app needs an update as well. If you can hurry up, get started. Just give me the regular countdown. There we go. 5 minutes until we get things going with our very first webcam stream. Apologies for the little bit of the delay we've had. All right, we got about 3 minutes to go until we get this thing started. And when the clock hits zero, the webcam will pop on and we'll have our very first webcam address. And we are finally doing this on a new computer, so there's actually a very, very small delay between when I'm talking and when you're hearing it. So hopefully that'll be helpful for being responsive to the chat. If you are waiting for this thing to get started, thank you for patiently waiting. 2.5 minutes until we get this thing underway. All right, just under a minute to go until we get the landmark stream underway. And for those of you watching in the Discord chat, feel free to pop into the Twitch and the YouTube chat because once I get going on the stream, I'm not going to be able to look at Discord. So I'm going to have my eyes on the chat stream. So feel free to break the seal in there and pop in. 30 more seconds. All right, three, two, one, and we're gonna get this underway. Let me test out the, I guess, little control studio I have. We go to the full screen webcam. It's working. So, welcome to the weekly live stream. It's a very special live stream because this is the first one we've got a webcam up and we can look at you while we speak. So, that's gonna be fantastic. And we've definitely dragged our feet a little bit on that, but definitely excited to have this going on so we could look at you, talk to you, and get through this together. More for what's going on in the Twitch chat. I could already see you checking in. But let me switch back to the standard presentation where I will put myself, there we go, in the bottom left, and we will get this thing underway. So last week went pretty well for us. We took home about $1,499. I say about, but that is the exact number that we took home. And it was a really, really nice week. Obviously, we like to target that 1% per week. We came in at 0.88%, but what was so phenomenal, already messing up off the bat here. What's so phenomenal about last week was the fact that the S&P 500 dropped 5.17%. And in spite of that, we were still able to take home about $1,500, even though it was just south of a percent. Anytime we could lose this much, or I guess the market could drop this much and we take home a profit, that is a phenomenal result for us. So let's talk a little bit about how we did it. We squeaked out a little bit of a profit from the HTU wheel with 258 bucks right there. And then took home about 1,300 bucks off the SPX spread, so that was phenomenal. Super excited about those. I mean, really the only big loser we had this past week looking at it is TQQQ, which was a little bit of a leveraged index play on the TQQQ on the QQQ index, that is basically playing the tech stocks and Nasdaq. But as with any trade that we have that is losing, we like to think they're only temporarily losing trades. So in the long run, here is our plan on TQQQ. Cliffo, what's going on, man? Welcome to the stream. Here's our plan on that one, right? We saw at the beginning of the week we were down $12.53. Now it's never fun to be down $1,253 on a trade off the bat, but of course the good news is that we have a plan to get that money back. And I guess walking through the process of this trade, let's talk about when we first entered into it. Our initial break-even price when we sold the 26.5 strike puts was that 26.5 strike minus 0.6, giving us the 25.9 break-even price. And again, that's the initial position that we like to establish. We always want to start small, scale in if things get worse. And of course, things got worse last week because it was just one of the worst weeks of the year in the market. So we scaled in a little bit further. We didn't quite double down because 8 contracts of the 26.5 strike admittedly was a little bit larger of a position. Off the bat, it was about a 20K position where we, was worth about 11.59% of our portfolio. I personally think that's a little bit steep, and if I could do that again, I probably would have pared that down a little bit, which might be a little bit of hindsight speaking because we lost money on it. But with that said, we scaled in, but we didn't quite double down because of that large initial position size. So what we did was we got to the end of the week, we said, okay, look, we're down 1,253 bucks. We have 13 contracts in, so what strike can we sell where we can make back 1,253 bucks? And the answer was pretty clear. The 24 strike on TQQQ offered $1.22 of premium. That's going to bring in over, that $1,200 we lost. It's going to bring in $1,586 provided that TQQQ finishes above 24 next week. And that's going to put us at a net profit of $333 on that trade, which I think is phenomenal management, right? Excuse me, that's total reduction of 15.18%. Our break-even price is down to 23.75. And when we manage these positions at the end of the week, we always want to have the discussion of, okay, do we want to add more to this position, or are we okay managing the position by just rolling the strikes? And the way that I like to view that is take a look at that break-even price, take a look at where the stock price is. So long as your break-even price is below that stock price, there's really no need to scale any further in. So as long as we've got that going for us, I think we're in a good spot. TQQ finished at 24.60. Our break-even is now at 23.75. No need to throw more cash at it because one of the best lessons that we have learned, and I guess one of the most important lessons that we've learned so far, is that things can always get worse. Should I use some of the editing that I can do on this new laptop now? Ready? Things can always get worse for us. So there we go. We'll cut back to the standard presentation. But keep that in mind, $333 of profit when TQQQ has dropped over 10% on us. that's just fine. And that's kind of one of the trades, these 13 contracts that's anchoring this week we have coming up, where we could take home a potential $4,446 at, base profit, as we like to call it. But that was really the only place we really got tripped up last week. Of course, we had a little bit of red on the SPX spreads, and I think now would be a great time to talk about those SPX spreads. Because if we go to the SPX tab, we can see that we have opened 101 different SPX spreads, and we have taken home just over 10,400 and, well, not just over, it should be just over $10,000 of profit, right? We've taken home $10,436 of profit on these SPX spreads since we started playing them at the beginning of May. And the great part about these, and we can't emphasize this enough in such an up and down market, is you could play either side, you could handle the volatility, and you could roll these very effectively. The back of the envelope map, if we could. And the great part about this now is I have this docking station at my desk here, and it only connects to my work laptop, and it didn't connect to the old laptop. But now with this new laptop I have, it connects to everything. So I've got my keyboard in front of me, I've got my microphone, I've got the webcam up top, I've got the mouse plugged in. Before, I literally only had the microphone plugged in. So this is so great that I could quickly do all this maneuvering on the keyboard. But back to the point, when we were doing this initial estimation on SPX, we figured that we only needed to win about 67.50% of the time. And we calculated that by going to SPY. If we don't, got the keyboard in front of me, I keep forgetting. And if you go to SPY, what's interesting about this is one of the metrics you could pull up, and I still need to reconfigure all of my Thinkorswim stuff because this is a new computer, obviously. But I believe if you, where can I right click here? One of the option theoreticals is probability of touching. And we calculated the odds that we have right here, and I could alt tab right back. That's so nice. We calculated these odds because it's not win or lose, right? We like to bail out of the spread when it gets breached. So the idea when it gets breached is when it gets touched. So if we go to Thinkorswim, we use this probability that it touches to estimate a roughly 67.50% chance of success per spread. And again, that was our initial estimation without having placed any of these trades. And with that math at every single trade along the way, with this martingale-like approach that we've put into play, we estimated that would bring us about a 4.76% return of expected value per spread. And what's great about this the initial estimation that we had up front is after 101 different spreads have been opened, we're at 68.32%. So we're almost dead on with our estimation. And if anything, we're on the good side of it, right? We're coming in higher at what we try to conservatively estimate for what mathematically would make a really nice trade for us. And of course, with these results where we've taken home over $10,000 of profit, that's exactly what we've seen. And we do have a, let's see, why is my chat not working on the screen? We'll figure that out later. But we could pull it on here. We have one comment from Raisha, hopefully I pronounced that correctly, saying, you wish you understood this. There is a lot to learn about option selling. If you come into our Discord server, you go to hourglass-trader.com. There should be a link to join in there for free, and you could learn everything by looking at the videos on our YouTube channel. But definitely there are a few steps to get to the level of understanding for option selling, but I think it's one of the most worthwhile strategies out there, and would absolutely recommend taking that time to try to follow along and learn what we're doing. So we scroll down a little bit more here. I mean, everything went pretty well, right? We have a bunch of small base hits, and that's the type of philosophy we like to have in this market. A bunch of small base hits that add up to really nice numbers. So even if we kind of shit the bed with one position and TQQQ loses us $1,200, it doesn't matter because we made $1,500 overall because we have so many other positions that are adding up to really, really nice gains. But at the end of the day, a phenomenal result to take home $1,500 when the market dropped 5.17%. And I think this is a very good place for us to demonstrate how we've kind of learned our lesson about how some of this has gone. Because last time the market dropped over 5% in a week was, let's see, the third week of the year when it dropped 5.79%. And we lost $23,000. So I would say a $1,500 profit now as opposed to a $23K loss, if I could find it again, is some marked improvement right there in that regard. And if we go to our 2022 year-to-date summary, that's 11 profitable weeks in a row for us. We did highlight that a little bit in the Discord server, so not to beat the dead horse too much, but that's 11 profitable weeks in a row during a stretch where we've taken home $34,349. So it's been a great run in the market for us. If you look at our performance versus the S&P 500 and NASDAQ, which is that one thing that we really, really like to look at and we kind of like to hang our hat on, We are starting to pull away. Now, this positive amount, we are on track to break even with what we have next week, but that includes this number that we haven't profited yet, so we're not technically there yet. We are going to hold the celebration off for when we actually get there. But with that said, we're outperforming by a very decent amount, right? We're leading by 17% over the S&P 500, and we're leading by 25.9% over NASDAQ, which is fantastic and exactly where we want to be. We've always said that, look, as long as we outperform, look, if the market could be red, if we're just slightly less red, I consider that a successful year. If the market is red and we could find our way to be green by the end of the year, I think that's a phenomenal year, especially coming off the heels of how well we did in 2021. So with that said, I think we kind of prove every single week that we're starting to build this safe, reliable strategy that can have some long-term success regardless of what's going on in the market, right? Because let's not get it twisted. At the end of the day, our HT wheel is a very bullish strategy, right? We're playing all these stocks to either stay flat or go up. We benefit from the market going up. But despite the fact that the market hasn't done that recently, as evidenced by the performance over the last 2 months, and we've still made about $20,000 over that month and a half, that's the evidence. And my camera has fallen down. Oh no. Come back here. All right. We're set. Good. Don't move. Perfect. So back to the weekly tracker. Really not too much I want to talk about from last week. I think it would be a much more interesting conversation if we talk about next week. We could talk about some of the positions that we rolled into and kind of go from there. So at the very top of the list is DraftKings 17.5 strike put. We had DraftKings 17 strike put, but I'm a fan of DraftKings. Like, if it runs away from us, I want to keep getting a little bit of cash out of it. So I'm happy to continue playing it. And for those of you who have been following us for a while, you know this DraftKings is a really long, winding trade, right? Where we had the 9-9 17 strike puts. Let's see what we had right here. Excuse me, this was the 9-16 17 strike put for 41 cents. And then if we add up what we've got coming for next week with the 9-23 17.5 strike put, and we throw that into our little DraftKings trade breakout right here, what you're going to find is that our DraftKings overall profit is now up to $1,430, despite the fact we have a long way to scroll up here. But we started playing this thing at 36 a share. It's down to 18.6. It's dropped basically 50% on us and was lower than that at one point. But despite that, thanks to our option selling strategy, the HT wheel that we've put into play, check it out. We have a profit finally on DraftKings. So we have finally made it to the light at the end of the tunnel. We're down to a safer 10 contract size. And again, we always want to think about scaling into positions in a volatile market. And that is what we have room to do. We could happily go up to 20 contracts on DraftKings. We've got Mahir in the Twitch chat requesting my age, address, credit card number reveal. If we get back up profitable this year, that'll be next week. I can answer a couple of security questions for you. Carter wants the social security number. We could do that too. You know, if we make enough money, I will just compromise my identity live on stream next week. So, you know, stay tuned for that. But SoFi, another one that's been really, really good to us lately. And I thought the premium on SoFi for this upcoming week was phenomenal. And these are stocks that we have on our watch list. Again, we emphasize the importance of a watch list because it's important to understand, you know, get used to the movements different stocks have, what premium typically looks like on a week-to-week basis for different stocks, and what levels you could expect stocks to bounce up from and bounce down off of. SoFi, the 6-strike put, 22 cents is kind of far and away above what I'm typically used to. Now, there is the FOMC where the Fed is going to announce the rate hike, and we could quickly look right here. If you can go to Google, type in FOMC odds anytime you want to take a look at this. But we've got the rate hike percentages. Basically, it's 80% chance of a 75 basis point rate hike and a 20% chance of a 100 basis point rate hike. So, you know, obviously the higher rate hike is a little bit more bearish for the market. And previously, like a week ago or even a month ago, there was a roughly 0% chance, even a week ago, of the 100 basis point rate hike, which is what we've seen the downturn in the market starting to price in via this 20% probability. So the way that I interpret that is typically by the date of the meeting, it's kind of solidified, at least what the market feels. If there's a big surprise, and we haven't had a big surprise yet, but if we take away this more bearish uncertainty, I think a 75 basis point rate hike is going to give investors the clarity that they're looking for, and I think that's going to be a very positive thing for the market. Now, if we get what would be considered to be more of a surprise 100 basis point rate hike, that could spell some trouble. But we'll cross that bridge when we get to it, and we'll stay conservative in the position sizes that we have until that point at Wednesday afternoon at 2 p.m. But yeah, back to the point. SoFi 6-strike put, That looks great, right? It's almost 4% ROR right there. Selling 10 of those, bag 220 bucks. Move on to the next one. Peloton 9 strike put. And again, we're kind of just going back to the well on positions that we've opened previously. Like with Peloton, we bagged $230 of profit off of it last week. We got what? A little bit more. So over the past 2 weeks, we've made 720 bucks off of these Peloton cash secured puts that we've been selling. So we figured why not go right back and sell some more. So we could potentially take our cumulative profit on Peloton up to 930 bucks. And that's just as long as it stays above that 9 level. Now that I got the keyboard right here in front of me, we can alt tab a little bit to switch back and forth. Let's take a look at some of these levels. This is the 1 year chart right here. Let's go back to the 20-day. And again, this 9 level is fantastic. We could, oops, I gotta actually switch to the drawing tool again. But if we go to that 9 strike, that's right there. That's a level I'm perfectly happy to jump in. Again, with just a half size position on for Peloton. And if we go back here, we'll see that that 9 strike put that we sold for 21 cents of premium gives us a break-even price of $8.79, I think is correct. So even further, our break-even price is down here. Max profit, this red line. Break-even price $8.79 right around here. And I also made the numbers and letters in Thinkorswim a little bit bigger, so hopefully that's a little bit easier for you guys to read at home on the stream. But again, this is why we like these types of trades so much, right? Peloton finished at 974 last Friday. We make money if it stays above 876, right? It's kind of a race against time. If you bump this thing into a 5-day chart, yeah, there's a decently large range between 1125 and 948, but where do we need this thing to go below for us to not make money on this position? We have to zoom out, and the answer is right here. I like our odds for that. It is definitely a race against time, and that's the type of position we want to keep putting ourselves in week after week after week. UVXY I'll circle around to because I think that's a little bit more interesting of a position, and we could kind of model that one out a little bit on the options profit calculator. But Affirm, last week, this is a great example of rolling a trade, right? Previously, if we go a couple weeks back, we've had these Affirm positions where we just sell 5 contracts at a time for like $1. There's Affirm again. Did we play it the week before? No, I think that's when we started. But again, 2 and 3 weeks ago, we've made $1,000 off of Affirm just from these 1/3 size positions. We did have to size up one time, and that actually resulted in us getting more profit. But the idea is a relatively conservative trade where there's decent amount of implied volatility on Affirm, and we're running back to the well again. Last week was the first time that we actually lost money off of one of those. We lost 275 bucks off of Affirm, which is obviously not great, but we roll down, we roll out, and we just kick the can over to next week. So the $275 loss here was at a 23.5 strike. We rolled that down and out to a 22.5 strike. So if Affirm stays dead flat where it is, and that current price again is 22.30, we're going to make $585 off of it this week to net out to $310 of profit. So in short, Affirm basically, when we started playing it last week, I think it was like 24.50, but it could have gone from 24.50 to 22.50. And even though that's like a 10% drop in the price of the stock, we would still take home about $300+ on that one. So that's a great example of how flexible this is. And that's without us even needing to increase our position size. We're kind of taking things on a week-to-week basis here, so we'll see that our weekly break-even price on Affirm has not been updated by me yet. Very bad, very bad. But it's that 22.5 strike minus the 1.37 premium. So plus 22.5 minus 1.37 means that our break-even price is 21.13. Stock's at 22.30. That as long as it doesn't drop 5% next week, we're making money on Affirm. And if it does drop to 21.13, that's fine because our plan B is just to add 5 more and lower that break-even price below 21. And that's a decent price to be getting Affirm at, because if we look at Affirm over the past month or so, we go to the last 20 days. I mean, this thing was at 35, and that's not just a huge... Look at that 180-day chart. We've seen it bounce in the high teens. We've absolutely seen that. There's some strong levels in the low 20s where it currently trades. But pretty recently, this thing was pushing 40 a share, and we now have the opportunity to get back in on it right around that 20 price level. So let's pop back over here and talk about the rest of the list that we've got. Palantir 7.5 strike put. Again, when you've got good premium one week on something, and we did identify good premium last week on Palantir, you know, look to those first the following week. You're probably a little bit more familiar after trading it for a week about how it's going to be trading on a day-to-day basis throughout the week. So one, you've got a stock you're already more familiar with, and two, you've got a stock where premium was high last week. So in all likelihood, it's probably high on premium this week as well. So we went right back to it, right? We actually made an identical trade. Last week, we sold the Palantir 7.5 strike puts for 14 cents a piece. And this week we sold them for 14 cents a piece. So we're trying to bag another $140 right there. We've got capacity to add 10 more of these if we decide that we need to do that. But again, that's a defensive type play in my mind. If we never have to touch these, that's fantastic. Easiest 140 you'll ever make. Opendoor, we lost a little bit of cash here, but again, we started small, similarly to how we have Peloton, how we have Palantir, how we have SoFi set up this week. Opendoor is set up to where, look, we lost 320 bucks because we started with 10 contracts last week. Yes, it's never fun to lose 320 bucks, but what do? We roll down, we roll out, and we increased our position size. Typically, we'd like to double that position size from the previous 10 contracts that we had to 20, but we went with 15 this week just because of the FOMC, the Fed rate hike coming. We just want to play things a little bit more on the cautious side. And in a market that's as volatile as this one, that's never a bad move. And we've been playing cautious lately, and that's led to a massive profit streak. So even though, in theory, some of the position sizes and strikes we sell are a little bit conservative, conservative doesn't necessarily mean that we're not making a lot of money, because we're doing very, very well lately. And I feel like I've been transparent enough when we were not doing so well, when we set like 40 grand on fire in January, but nothing wrong with calling attention to the fact that we've done very, very well lately against the market. So moving down to TQQQ, we talked about that one a little bit at the top of the stream. This is just the idea of getting back in the game on this one. We lost 12 grand, not 12 grand, that'd be bad. We lost 1,200 bucks on it last week. Hopefully can make back about 1,500 this week, and that'd put us in an overall position of profit. And the great part about TQQ, right, we've got these weekly options. We get head right back to the well on this thing. So, and if you look right at the money, about that 24.60 level, you're looking at about $1.50 of premium per week. So even though this last week we were only able to get ourselves down to 23.75, if we hit this same trade again next week, we knock another $1.50 off. That's just down to 22.25, right? You want to have plan B, plan C, plan D in the back of your mind when you're running through these trades. And if you look at this, look at the chart here, yes, it's coming off a pretty big rip to the downside, and that's exactly when we like to enter these things. But decent support here, down in the low 20s, right? This line right here is 24. I kind of missed the bottom of it a little bit, but as you can see, that bottom out to the right of the screen is at about that 22.5-ish level. And like we talked about, if we knock another $1.50 off of this, we're going to get down below that 22.5 level. So I think this is a perfectly acceptable trade to stick with in the coming week. And if it gets worse, it gets worse. We have capacity to add some more, maybe one more time. But so long as this break-even price is below the stock price, we've got nothing to worry about. We're smooth sailing on that one. So back to the main tab. AMD was a great one last week, right? We love to talk so much about some of those trades on Thursday mornings. When you see a stock that's very, very red, you take advantage of that jump in premium, you sell something along those lines, and then either on Friday you close out for profit, or you take advantage of the still high premium and swing that trade into next week. AMD was an awesome example of that. We sold one of them, one of the 76 strike puts last week off of the big dip on Thursday. We bagged 63 bucks of profit, which isn't like, look, one of those don't spend it all in one place type profit sums. But we made 63 bucks. That's never a bad thing. And we were able to get into next week a much lower strike. We went from a 76 strike to a 72 strike, getting that same dollar premium. So hopefully we could take home another 100 bucks of profit. And again, to put this in context of what the chart looks like, that 72 price level is significant. Why did we pick this one? Because it's right where it bottomed out previously at the beginning of July. So I think that's going to be a really nice level of support for us. So we've got that working for us. A big cushion and a big level of support at that cushion that we sold down to. And if it never even threatens this, it runs back up to 90. You may say, oh no, we could have like bought calls or something, but we never want to think like that. We want to think that we're happy to take home that 100 bucks. Unity has been the one that's really good. Last week we sold the 35 strike put with the idea that, hey, we kind of want to play this in the lower 30s, but a 35 strike put gives us like a 34 break-even price, so maybe we're okay with that. And that one cashed out for max profit, and it still dropped, but we still made max profit because of that cushion we like to sell with. The great news this week is we're able to finally get that low 30s strike at a 33 strike, 68 cents of premium, so we did 2 cents better than last week. Look at that. So we potentially could take home about 340 bucks in profit on that one. MindMed, this is a great example. I don't know if J-Rock from our Discord server is watching this one, but if you think about what we've done on MindMed, last week we closed that one out for $348 profit net of the 186 we lost on it the week before. We closed it out for $162 of profit, which again, another one you might say 162 bucks, whatever. But if you look at MindMed, What's happened with this one is it has dropped insanely from when we first got in. This thing's at like an all-time low. They had a 1 to 15 reverse split. So what happened between basically the end of August and now is this thing dropped 50%, which is a very significant drop for a stock to take, yet we still made money on it. So that is one of the advantages of playing some of these higher runner, these huge IV spikes, right? I know a lot of you guys who are in on the IV reversion trades with us, you definitely recognize this chart shape right here. And that's something we like to hit on very, very often. And if I could add the study for implied volatility, which if I go to HI, where are you? Imp vol, there we go. You see that big spike in implied volatility. It's come back down a little bit, but we did jump in on some of these October 5-strike puts because if you go to the option theoretical in Greeks, the ROR here is massive. It's a 7.07% ROR. We know in our trades, typically we like to target 1% ROR per week. This is 33 days till expiry, so basically 5 weeks away. 7% ROR in 5 weeks is just a hair over 1% ROR per week. So mission accomplished. And again, this would give us the shares at 470-ish, which is all the way down here. So a very, very safe place, I think, to initiate a position on this should it come to that. And if it does get back down to there come October 21st, I imagine there's going to be a decent amount of premium at that 5-strike to, consequently then sell covered calls on and run the old HT wheel and get that basis down. So that is the end of the list that we have for the coming week. We ran through that in a pretty decent time. So base profit, meaning the profit if stocks moved neither up nor down, is $4,446. That's good enough for a 2.51% return next week, and enough, most importantly, to get us to a $1,211 profit on the year, meaning we will have finally broken even after setting 40 grand on fire, slightly recovering, and then proceeding to set 30 grand on fire in April before saying, okay, we need to change up the approach a little bit. But I think changing up the approach has been very successful so far. Since the beginning of May, we've taken home about 45 grand to dig us almost entirely out of that hole. So that's what we're going to be looking at this next week. FOMC is coming up. I'd like to normally, look, when the market drops 5%, normally I'd be loading the boat and anticipating a little bit of a bounce. But with rate hikes coming next week, I'm going to delay that by 1 week. So maybe not if we pull the little calendar up. It doesn't come up when I click it on here. Bummer. Hate to see that. Anyways, but not this week, but the week after that. So about 7 days from now, or I guess this Friday, if the market is still low and we have another red week, I'm going to start to load the boat and get aggressive. The reason being is the whole idea behind this a little bit more conservative approach that we've had for the last few weeks, and I guess maybe a few months at this point, is that we look back at our 2022 profit by week, right? We have these big, huge red weeks. Now we do have some big green weeks sprinkled in here, right? There's 23 grand right there. There's 11K. You see 17 grand, 23 grand in a week. I think I already clicked that one. But you get the point. There's these big green weeks, and we love the big green weeks, of course, but with the way that our strategy works, these big green weeks are made possible by the big red weeks before them. So the idea is we start a little bit more conservatively, wait for what would have been a big red week. And again, this previously would have been a huge red week for us, right? This negative 5% of the market, as we previously demonstrated the last time that happened, we threw away 23 grand in a week. So where that previously would have been the big red week that we just saw, we want to take this opportunity to then scale into the big position. So on the back end of it, when we did lose that 23 grand, that was followed up by a period where we made 22 grand over the next 3 weeks. So avoid the red up front and scale in so we can still take advantage of similarly sized profits on the back end. So that is our goal. And again, we want to hold off a little bit just because of the rate hike coming this week. But next week, I'm probably going to put the foot to the gas a little bit if the market stays down. And if the market doesn't stay down and it bounces this week and we say, oh no, we should have scaled in this week and made $10,000, guess what? $4,446 is not too bad of a consolation prize either. So that's what we've got cooking for next week. So we got a little bit of time left here. Let's hit the scans, see what we could find for the next week, and try to come up with some ideas in case we see some opportunities on a week-to-week basis. So I have to actually load all these in again. So we're going to start with the good old high ROR puts without earnings. Again, this scan is just going to objectively give us the highest premiums in the stock market, or I guess the options market, however we want to say that. And I also need to adjust this. This will be a quick little Thinkorswim 101. We like to talk about things from a perspective of ROR, return on risk. This may drive you crazy if I scroll for it. So return on risk, let's throw that in there. Let's get all the Greeks out of here. I honestly don't care about those too much for what we're looking for. And click OK, there's ROR. And we want to sort these again by, what am I looking for here? Return on risk. We want to sort by return on risk, descending to give us the highest to the lowest. Tick tock, tick tock, tick tock. And there we go. We now have a list of the highest paying options in the market. And again, the big caveat with this when we do this is just because something is at the top of this list doesn't necessarily mean that it's a good investment. I think Getty is a great example of an option that is not a great investment, because Getty, for example, is one where it was running up a ton. And again, those of you who follow us, watch these streams with me, and have studied the SPACs the way that we have, this is a very typical chart. The thing stays dead flat at 10. They undergo the reverse merger. There's a huge squeeze because all of the shares get sucked out of the market when people redeem for 10 a share. And then it inevitably comes flying back down. We've seen it with several different tickers. We're going to have to go to the 3-year to see this one. Boom, you see it like that. IRNT, maybe RKLY. You know, very, very common. And now FaZe, I think, is kind of the next man up here. So you're seeing, you don't really get to see pre-merger here on this chart for whatever reason, but it ran up to 24 and it's fallen back down. You see a huge red candle from 18 to 14. But the idea here is that this thing's going to be falling down probably back to single digits before the end of the year. And you may say, well, why don't you just buy puts? And if you go to January and you want to play that by the end of the year, these puts are so expensive. So that is, you know, we're not the only ones who understand this thing is going to be a sinking ship, right? If you want to open a 5-strike put, the thing has to drop down to like below 4 for you to even make money. So you could be right and still lose money. And that's kind of why we hate buying options in the first place. So I'm going to take a sip of my water from, here we go, we got the camera. This is the HT Yeti tumbler. Here we go, officially branded right there on the back. If we get to 30 viewers on a live stream, we will give one of these away to someone who is watching. So probably I need to do a better job of advertising, but now that we got the webcam, maybe we could get the marketing going a little bit better. But again, these are the tumblers we'll be giving away. Phenomenal. So back to the scan. Main idea we're getting at here is FaZe, not a good result. Getty, not a good result. Rev is Revlon. It's a bankrupt company, not a good result. AMRS, I have no idea what this is, so let's learn together. Ameris, it has a 45-cent market maker move right here. Seems like it's priced for much, maybe not much more than that, but again, a 3-strike, if you get a 10-cent fill right here on a 3-strike, that's over 3% ROR. Now the question here is, do you want to own this stock at 3 a share? And I think that is a resounding no, right? If we draw the line at 3 a share, this is just the 180 chart. This is very, very short-term history over the past 6 months. This is not a price point that I would like to own it at, because as you can see, between the times of May and what is that, mid-August, thing was trading at about $2 a share. So that's not a place I'd want to get in at. Move down the list here a little bit. PACB. Let's take a look at PACB. ACB. Accidentally typed in POACB for all these accountants out there. 23, we've got a decent ROR, and I want to change this to volume so I don't keep looking at 2 different percentages and get tripped up. But we've got, again, you can't really tell here, there wasn't a lot of volume, but you've got a hell of an ROR at the 6 level. This is a bioscience company, like it traded back down at the 4-ish level. IV isn't necessarily high or anything like that, so I'm probably leaving that one alone. We go back to the scan. Not a ton here. That looks great at the very top of it, but again, what's the best part about this scan? To me, the best part about this scan is when we use the intersect with feature. So we know that like there's all this going on. These all obviously have decently high implied volatility. But what we can do is say, okay, of this list of 1,000 different options, what if I want something that's oversold where RSI is low and implied volatility is high? I think the intersection of those two things historically have done very, very well for us and have been the basis behind a lot of different successful positions that we've identified on this screen. So what we want to do is intersect it with, again, the oversold, where's HT oversold stocks? There it is. And we want to exclude futures. We scan, and it goes from a list of 1,055 stocks to a list of 10. So we've got a very nice, much more focused list. And now is the self promo part of this, where if you want to get access, if you look at Thinkorswim right here and you see us go to load scan query personal public, you see all these custom ones that we've made under personal, and you want some action on that, you could go to hourglass-trader.com and you could go to join HT Premium. And again, once you're in HT Premium, all of the privileges that you're going to get are right about here. And you can go to option scanners and we'll have links where you could load those in as well. But above, I guess, beyond that, you could join our Discord server where you get alerted to every single trade as we make it. So you could join in the same stuff we are, trade along with us, learn the strategies. We've got a premium chat room where people roast me. We're Billy Dean. Mahir, he predicted that I look like this. I think he might be the leader in the clubhouse for appearance. I wore the blue shirt for him though. This was that part was planned. But we've got a pretty active chat room on a week-to-week basis in there. You get all of our trades. You get alerts to when there's spikes in implied volatility. You get alerts to when there's halts in stocks. And that is the end of my spiel. But hourglass-trader.com. 1 week free on the monthly HT Premium if you want to give that a shot. But back to the good stuff here. So XPEV is like a Chinese EV company. I am not a huge fan of one, EV companies, or two, Chinese companies. But again, if you want to get in here, I mean, just understand that's the kind of risk you're taking on. Personally, I'm not going to do that. Let's bring in RSI here as well, because these are the two metrics we like to take a look at, RSI and implied volatility. So if we go to RSI again, these are the types of stocks that this scan is going to isolate for us, right? You see it get into the blue. We love when stocks get into the blue because they typically bounce, at least in the short term afterwards. When we're trading weekly options, the short term, that's kind of all we need. So if we go back to the scan, look, I'm not a huge fan of XPEV just because of that EV risk, the China risk. That's just a little bit too much for me to bite off. And we know that our recourse or our defense that we could play here is owning the shares if they drop down, and that's just not a stock I would want to own. ZIM is one that's kind of been on our radar for a little bit because I believe we played it in the 40s for a little bit of time, and this thing has absolutely fallen off the face of the earth over the past month or so. So it peaked at 91. They pay a fat dividend. Not the worst stock in the world to own, but if we go back to the 3-year chart here, this is heavily dependent upon overseas cargo and shipping rates, and those have been dropping a lot lately. And I'm not gonna act or opine as if I'm a huge expert on shipping rates, so I kind of defer to Twitter research for a lot of that. But based off of what I saw on Twitter, those who are in the know consider maybe low 20s to be an entry point on ZIM. So we'll keep an eye on it just because it's getting hammered and we'd love to get in it, maybe 20-ish. But on a week-to-week basis, premium's decent, right? You can go decently out of the money and still get 1% ROR, but we don't want to be doing that quite yet. So keep that one on your watch list, keep an eye on it, and when it gets down to that like low 20s level, I think that's when we're going to try to pounce. A couple repeats, XPEV, ZIM, WDC. What's WDC? Western Digital Corp. Do I have any idea what Western Digital Corp is? Absolutely not. Let's take a look at the 180-day chart. Looks like earnings risk is behind us. And again, with this scanner, these are all options without earnings, so we know that there aren't going to be earnings risks on anything we look at today. But what we do like to see is that blue on the RSI on a 180-day basis. This thing's getting, it's at a 180-day low. If we go back to a 1 year, it's a 1 year low. This thing's getting hammered. Let's check live news. I think one good way to quickly, get through what a good price is or is not is looking at the price targets. We've got a $30 price target on this thing. We've got a $35 price target. Those aren't phenomenal, to be honest with you. 34 right here back at the beginning of November. We've got one at 52, which is seems a little bit contrary to what's going on. And one other thing we could do really quickly if we pop into that Discord server again is we've got a bot in there, and anyone can use this bot. So if we pull this back on screen really quickly, just go to the charting channel /DD and you go to analyst and you type in WDC. It's going to quickly pull up a list of analyst ratings for Western Digital. So there you go. Instead of having to go through that news feed that we just went to, we see that 30, we see the 34, we see the 52, and we see the dates that they were either initiated or downgraded on. So we've got that, and that's a cool little tool you can use to help your research along the way. So with that in mind, it looks like mid-30s is where people think this stock should be. On a week-to-week basis, 36 has, it has premium. It's definitely there.
From a scaling in perspective, we wouldn't necessarily want to take a full size position at 1% ROR, but rather a half size position at about 2% ROR, and that comes at 36.5. 36.5 has about 70 cents a premium. That's a 35.80 break even price. Let's go to the 10-day and see if we can wrap our heads around a 35.80 break even price here. And that's going to be right there. I mean, I'm not a huge fan of it. It's gone from 44 to 37 in the course of 5 different days right there. It already dipped down to 36.32 last Friday. I'm just not confident that's a good enough price level. I'm not a huge fan of this company or anything or like that, so probably going to leave WDC alone. UPS is the last one on here, which is kind of interesting. And what I thought happened last week, there was a huge drop, right, which relates to FDX, FedEx. You'll see a massive drop. I initially thought that this massive FedEx drop was earnings. It was not earnings. They actually released some news. I forgot exactly what they said, but point being, what was last? Warning on economic trends is what happened. So it wasn't even earnings. In fact, FedEx earnings are next Friday, which is why I was so shocked that UPS, none of the premiums were priced for this, and it's because it wasn't earnings. But again, they have earnings next Friday. UPS may be priced similarly for a little bit of a sympathy type move. But again, this isn't anywhere near enough premium for me, in my opinion. Maybe one thing we could potentially do here, because I think the implied volatility on this thing's got to be getting out of control. If we go back to the studies, quick studies, yeah, implied volatility shooting up there. If we look at it on 1 year, I mean, definitely not as high as it previously was. It was kind of in the gutter there for a little bit, but off this big drop one, you normally expect to see a little bit more implied volatility off that steep of a drop, right? We saw back in the end of March when it dropped from 223 down to 189. Look how high the implied volatility got around this time. It's way up here, and it's not even close to getting all the way back up there quite yet. So that's something we'll want to keep an eye on, but maybe not necessarily the time to strike. But on the 1 year, you could look at some of these places. Like, look, 170 looks to be pretty decent support on a 1 year basis. UPS is a solid stock, right? But we have seen this trend of a lot of these companies going back to pre-COVID highs. Pre-COVID highs for UPS are 124. That's a long way away from 176. So 170 seems like an okay number to get in at. However, the issue with 170 for me is it's still a little bit far away from here, and you're only getting about 1% ROR on that. And if you want to do that, definitely a safer stock to potentially get in and do that. But you have FedEx earnings risk next week. That's kind of one of those sympathy events that you might be best to avoid. But now that we took a look at some with no earnings, we didn't really see anything too great out of there. I got to be honest. I think what we've got lined up in our regular profit tracker for next week is a plenty good list. We're not really hurting for ideas as it currently stands. But let's take a look into the earnings side of things, because we talk about having all these positions that we have in our profit tracker. They're relatively connected to the overall market. We want to take some, maybe not take some risk, but take on some trades that are outside of general market direction risk, and that's going to be earnings, where their price action is going to be far more driven based off the results of those earnings, as opposed to the results of like something like a rate hike. So we're going to start this over. We are going to, what are we going to do here? We're going to load our scan query, personal high ROR puts with earnings. And let's just take a look at the highest ones. So this is going to be exactly like the first list that we saw, except it's only stocks that have earnings this coming, I believe, the week. Yeah, 7 days. So Nike, Costco, FedEx, you see that one coming up right there. But if we sort these by ROR, you can see Stitch Fix is one on there that's reporting earnings next week and has some massive, massive, massive option premiums. So let me double check the Stitch Fix earnings date. The best way to do that, just go type it in right there at the bottom. Click on that, 9:20 aftermarket Central Time. So that's going to be Tuesday after hours. We go to Stitch Fix. Could their business completely implode on Tuesday? Yeah, it could happen. Who knows? But if we go to the 20-day, you'll see that it's trading basically at an all-time low, which probably is better illustrated by the 3-year chart, where the all-time low is 461, which was established last week, and it closed last Friday at 478. So this one has earnings coming up. Implied volatility is getting up there. I mean, implied volatility on this one is basically at an all-time high as we approach earnings. There's some very, very decent premiums that can be had on this one. I got to be honest with you, I love the idea of the 4-strike put here as an earnings trade, right? Because if we pull our handy dandy system calculator up here, and it loads so much faster on this new laptop. But 478, right? If we sell a 4 strike, we sell it for 15 cents a premium, being conservative. That's a 3.85 break even price. That is what? Minus 4.78. It's 93 cents away from 4.78, which 93 cents divided by 4.78 means that the stock would have to drop 20% on earnings for us to lose money. And again, if it does drop 20%, it's not like that's necessarily the end of the road. We just have stock at 385. We could turn around next week, and they have options at 50-cent intervals. The market maker move on this one's 27 cents, which implies that the low end of the range of potential movement is about 450. And even even like the expected move is only $1. So 378 is kind of the low end of the expected move. 378, that's kind of right in the neighborhood of what these 4-strike puts are offering. I love the idea of maybe taking a bite out of these Stitch Fix 4-strike puts for the coming week. So let's go put this over here as we start to build out a little bit of like a bullish SFIX 4P. Earnings are going to be 9:20 p.m. Maybe that's a little confusing for pre-market. How about afternoon? And then we're going to change the alignment on this so it doesn't look like garbage. Okay, cool. So we've got Stitch Fix 4-strike puts. I think that's a decent one to come out of this scan. We could also take a look at Bed Bath & Beyond, which has earnings. This one's a little bit more interesting. Does Bed Bath & Beyond really have earnings? Let's type it in. Let's see. 9:29. No, they do not have earnings next week. I don't know why that one showed up. Interesting. So we'll ignore that. But let's see. FedEx, we know, has earnings. That's decently high premium. And FedEx is an interesting one, right? Because we just saw that FedEx absolutely fell off the face of the earth. Why did they fall off the face of the earth? Because they essentially warned that there's going to be all these economic issues. So what happens when that, occurs? We can see this massive red candle, right? People, once they gave that warning, are essentially pricing in bad news from earnings that's coming up. I feel like it's almost them giving a heads up like, hey, our earnings aren't going to be good. Over the past 180 days, FedEx has gone from 266 to 162, and you already have this pricing in. I mean, it's dropped $40. It's one of those things where once you're prepared for the bad news, how bad could the bad news really be, if you know what I mean? So that's what we're looking at right here. And with the extra earnings boost, right, you got implied volatility cranking up. You've got some decent ROR, decently far out of the money. Yeah, I'd like to go a little bit further out. I mean, how far out of the money can you really go on this thing? Doesn't look like a lot of these currently are for sale. But you can get 1% ROR at a 150 strike, which is okay-ish, right? We talked about that trend of falling back down to pre-COVID highs. Where is the pre-COVID high? The answer is it's right at 166, and it closed in the low 160s. And that's kind of why that idea of a pre-COVID high is so important, because when does the free fall stop? When does the free fall stop? Right when it gets into this range that it was in before the COVID drop. And that's why we want to keep an eye on those levels. That's why when we pulled up the UPS chart, we weren't really a fan of UPS at this levels, because the pre-COVID level is, far, far further down than where it currently sits at. Where if you compare that to FDX, the pre-COVID level, it's right in the wheelhouse right there. So if you sold a 150 strike put, 150 is not the worst place in the world to be on this one. The only thing that would maybe give me a brief moment of hesitation is even just selling one contract on this would represent a $15,000 position size. I just feel like if shit really does hit the fan on this one, it's going to be tough. I don't hate the idea of maybe stepping down to 145 and trying to take $100 off of it, and then getting a 144 basis where you could work from that 144 basis, right? FedEx isn't some, garbage Chinese pre-revenue company. It's a nice solid revenue generating company, well established. I don't think there's a ton of risk in that regard. But with that said, maybe we can give like a maybe rating on here. FDX 145 or 150 put, maybe. We might need to move that over so we could read that sell. So I think that's kind of, unless we want to take a look at Nike's kind of at the bottom of this list. There's not a ton. We've got Nike right there. Let's finish out the exercise here. We'll type in NKE. We've got 1% ROR down at 101, which is really far. That's not far away at all. When are Nike earnings? They're 9:29. Again, they're not this next coming week. Something needs to be changed in this scanner. So that is why the option premium isn't that high. But again, Nike is one that's trading right at that pre-COVID high. When did this downtrend stop and it started to level out? The answer is it fell all the way down to here and bounced back up right at that pre-COVID high. that is why we keep an eye on those price levels. The bottom end of that range is 93. We can maybe have a sneak peek to next week for earnings for Nike, and there's a 1% ish right around that level. So we'll have to see how that one plays out. But as it stands right now, I like the amount of risk that we have taken on currently in our portfolio. I think with a volatile event like the FOMC with the rate hikes potentially coming up, this is a very, very good place to be at. If we take a look at futures, and it's weird having net change here, let me customize this and make this percent change so I can make a little bit more sense out of this. Remove that. What are futures looking like? Futures are already down 0.25%, which is a decent little dip right there. So Monday could be red as well. I wouldn't be surprised to see a period of people de-risking from the market ahead of the rate hike. That's definitely a trend that we've seen before. We could take a little bit more of a macro look with the just insane. There goes the camera. The camera is gone again. Okay. Maybe step 2 for next week is to figure out where that camera needs to be positioned. But I think we're good. We're back. Perfect. But with that said, look, the base previously was 361. That's what it bounced off of. Looks like we're maybe starting to come back down to that level. I would not be surprised at all to see us get back down below the 3,800 level. And, ES is below that 3,800 level as it currently stands. So, yeah, I like the minimal level. I like the approach of taking minimal risk until Wednesday and just sticking with what we got. If you have any cash on the sidelines, maybe reserve it for trades like I guess ARQQ, like that was an IV reversion trade that got alerted to us in the Discord server. Something like MNMD where it could drop 1,000,000% and you're still going to be okay. Trades like that where we focus on like the stock halts, the IV reversion type opportunities. Those are the ones I think that I might want to scale into on Monday, Tuesday, Wednesday, because again, the benefit of those types of trades is that as the market drops, those trades are relatively disconnected from the market. And if the market's crashing and you've got something that's doing its own thing on the side, that's not too bad of a place to be. So that's what we've got cooking right here. If you've got cash on the sideline, either use it to manage your trades between Monday and Wednesday, but I really don't want to do too much between now and Wednesday afternoon. Is that a little bit boring? Yes. Is boring part of the strategy sometimes? Absolutely. I mean, I think if you take a look at most of the weeks that we have in the market, we spend less than like 20, 30 minutes actually placing trades. We kind of game plan. We set everything up like we currently see right here. We may do some day-to-day, 0-day SPX type spreads like we like to add up here where we added $1,300 of profit last week. But outside of that, as far as typical HT wheel type trades where we're adding to our core holdings, I think the smart move this week is just to be patient. If the market continues to dip, as it currently looks like it's going to do, as it stands with the way futures look, there will be an opportunity to add some of these at better strikes, maybe add some different trades, but we don't want to do that just yet. We want to remind ourselves just how long 5 days is in a trading week. A lot can happen in one day. I mean, just about anything can happen in 5 days, and that's been demonstrated by the volatility that we've seen so far. So hang tight. I mean, I'm sounding like a broken record here, but I think the most important point is communicating that part of our strategy where we're not going to do too much until Wednesday afternoon and beyond. So really, really nice base profit setup. Let the market cut into that, and once it starts trending towards zero, if it ever does, that's when you need to start jumping into action. But I think with what we have here, this is a great place to be. If you're not in any of these, I think these are great entries all individually. But again, make sure you have tons and tons of cash on the sidelines left to manage these positions. So for the send-off, instead of having you guys just directly stare, let's see. There we go. Nice Smith, what's going on? I accidentally minimized the chat. We've got 9 in the YouTube chat saying what's going on. Just hop on, have to watch the replay. Scared about the Fed meeting, and I will say to those of you who are scared about the Fed meeting, I think being cautious with your trades is a very, very smart thing to do in anticipation of the Fed meeting. But historically, what we've typically seen in the market is that the Fed decision is driven mainly off of the interest rates. Excuse me, that was duh. They're driven off the interest rates. The Fed decision on interest rates is typically driven off of the CPI data, and I think we've seen the market respond a lot more violently to the CPI data as opposed to the actual rate hikes themselves. So if we come through and see a 75 basis point rate hike next week, I think everything's going to be just fine. If we see a surprise 100 basis point rate hike, that is going to be when we are thankful that we have some smaller positions and some cash on the sidelines to manage those positions. So be careful for that, and that is our plan for the coming weeks. So we could go with our very cool fade transition back to the main camera. Thank you to all of you who tuned into our very first webcam stream. I thought it was good, you know. Switched back and forth between the camera maybe twice, so I'm very technically gifted. But you know, we might try to add some overlays, some more special effects, keep the viewer interested instead of the typical just staring at our little profit tracker. It could get a little bit boring, admittedly. But I think we've got a great setup for the coming week. Those of you who have stuck with us from the beginning, been following along, and made it to the end of the stream, thank you for watching. If you're watching on the replay, you know, we care about you all the same. But until next time, this has been the Hourglass Trader, where as time passes, we make money. There you go. You finally get to look at me, say that corny phrase to you in person. And hopefully we talk to you guys same time next week with more money in our pockets than we've got right now. So thank you, and we will see you day to day in the Discord server, or for the stream gang, we will see you same time next week. Thanks, guys.